Hello students, hope you are doing good. So today we are going to discuss the measurement of national income. Measurements of national income basically includes the various methods, okay, which we can use to determine national income. National income, as we have already discussed in the previous videos, is the aggregate NNP at FC, that is net national product at factor cost, right? So when we say determining national income, we have got different sectors in the economy, like primary sector, secondary sector, tertiary sector. So there are different methods which are particularly suitable for different sectors, but there is no hard and fast rule. So we can use any method to determine national income, in various sectors. Now, so first let us classify or categorize those methods. We have value added method, which is also known as production method or output method. So three names: value added method, production method, and output method. Three names for the same method. Second, we have income method, that is a factor income: land, labor, capital, entrepreneur, their income we are going to add, and we are going to arrive to particular aggregate. Then expenditure method, the logic is very simple. One's expenditure, yes, someone's expenditure is someone else's income, right? So we are going to understand the various types of expenditures in this, and when we are going to add those expenditures, ultimately we are going to arrive to GDP at market price, and from there we can determine national income, right? Okay, so in details we are going to study today value added method. So to calculate national income using value added method, we have very simple three steps, right? Step number one, first we have to determine value of output at market price. That is, what worth of good and services basically produced in the market. Okay, that is, it can be determined very simple manner. Like, if we have the information about sales and change in stock, either value of output is given in the question directly, or you can have value of output which is equals to sales plus change in stock. Change in stock, as we know, is closing stock minus opening stock. Change in stock is also known as inventory investment. Change in stock is also known as inventory investment. So value of output is equals to sales plus change in stock. It is very much possible that change in stock can be, as I just mentioned earlier, that it is also known as inventory investment. But sometimes sales may not be given directly. Okay, so what is very much possible? So sales can be price into quantity sold. So price into quantity can be used to get sales, whereas closing stock and opening stock are given directly. So value of output is equal to sales plus change in stock. Or it is very much possible that is given value of output in the primary sector, value of output in the secondary sector, value of output in the tertiary sector. So if we have got three informations in all the three sectors, we have got value of output, we can simply add and we can get the total value of output at market price. Step number two. Step number two, we have to identify the intermediate cost. Now, what are intermediate costs? Basically, intermediate costs are purchases. Those are made in order to produce the desired output, right? It can be, raw material. In case of agriculture, it can be seeds, it can be fertilizers, manures. Okay, but we are not going to take the machines and tractors and all, right? Because those are fixed assets and we charge depreciation for those. So do not consider depreciation. Do not consider depreciation as intermediate cost. Rather, intermediate costs are those purchases or expenses which are made on those goods which are used at once. That means they are used within one year, one fiscal year. That means used and finished. So those are not stored. Okay, so they cannot be used again and again. So example, as I already mentioned, you can have diesel, petrol, electricity, that means fuel, raw material. All these comes under intermediate cost. So these intermediate costs, when subtracted from value of output, we get gross value added at market price. So gross value added at market price is equals to value of output minus intermediate cost, we get GVA, that is gross value added market price. But you have to keep in mind one thing, and that is, if we have gross value added, how to arrive national income. Okay, so for that, what is important to understand, that gross value added at market price, when we have sigma, that is sum of gross value added by different firms, we get GDP at market price, right? So gross value added at market price of different firms, when added, we get GDP at market price. Now from GDP at market price, if we subtract depreciation, okay, so we arrive from gross to net, subtract net indirect tax, then we get from MP to FC, and if we add NFIA, that is net factor income from abroad, ultimately we are getting NNP at factor cost, right? So this NNP at factor cost is national income. Okay, so from gross value added, the summation of gross value added by different firms, we get GDP, subtracting depreciation, subtracting net indirect taxes, adding NFIA, we get NNP at factor cost, which is national income. I hope you have understood. You have to practice few sums. You can just let me know. I'll be providing you the practice material on the various platforms. Thank you.